This is breaking news from Bloomberg.
Last month was 114,000. It is revised under 100,000, 89,000, positive 89,000. So I've got 142,000 as the jobs report, and the 2-month revision is 86. So Paul, do the math with me. 6 take away 1 is 13. 8 is 51,000.
Yep.
I think 56,000, 56,000 positive is the summation with the revision. We jawbone along here, folks, to give Neil Dutta time to look at these statistics. Neil, what does this signal for Chairman Powell?
Get going. That's what it signals. Go 50 with a promise to do as much as necessary to stabilize labor market conditions.
So again, Neil, I mean, and you think about these numbers and the revisions, as Tom was just summarizing here, the labor market, I guess it kind of falls into what you were just saying minutes ago, not nearly as strong as people think it is.
No, I mean, the 3-month trend on non-farm private payrolls is running below 100,000. I mean, that's not a good number. That's barely break even. And I think it's arguably actually worse than that, because one of the reasons why the number even looked as good as it did is because we saw an uptick in construction employment among, I think, civil engineer contractors or something like that. And so that's not going to last, because everything we know about construction right now is that units under construction are collapsing. So why are we hiring all these people to build what exactly? That implies a margin squeeze for builders, which I don't think they can tolerate right now. So I think it's the goods producing side. I mean, Tom mentioned manufacturing. I think that's notable because a lot of people were thinking maybe you'd see some uptick in manufacturing because of the unwind of the retooling. It just didn't happen, right? And the good side of the economy is weak. Cyclically sensitive industries are sluggish. And, this is all about the Fed trying to create a handoff from income-led growth to credit-led growth. That's what this is about. So they need to keep cutting until the credit-sensitive areas of the economy turn.
Joining us worldwide, Neil Dutta. We are commercial-free to the 9 o'clock hour. Claudia Sahm, Mark Zandi will join in a moment. Ben Laidler will join us on the equity market reaction and the view forward here later in these 20 minutes. Futures at negative 17. The VIX was at 22 level, comes in nicely, 20.76. Major bond market adjustments, make it 8 basis points. 2-year yield 3.66, 30-year bond well under 4%, 3.98%, 10-year yield 3.67%. Neil, I want you to frame out for us what inflation will do given a depressed GDP and a job market moving. The second derivative here is moving to a worser space. What does inflation then do? Further disinflation?
I mean, absolutely. I think so. I mean, if you look at core goods, non-housing services, and housing rents, I mean, those are the 3 ways to slice the inflation data. The entire shortfall relative to the Fed's target is in housing rents, which we know will continue to normalize given the lagged, sort of nature of that indicator relative to market-based rents. Everything else is basically normalized. Again, I mean, what's the upside risk for inflation if growth is running below potential and the momentum under the unemployment rate is higher? I mean, unit labor costs are running basically flat for the last year. So there's no more of an inflationary impulse coming out of the job market. That story is completely over. And the Fed continues to run a very, very restrictive policy stance.
Paul, get one more in here.
And Neil, the unemployment rate, just for those that are going to be watching the headlines, it stays steady at 4.2% here, right in line with expectations. What does the Fed think about an unemployment rate of 4.2%, do you think?
I don't think they should think about an unemployment rate of 4.2%. I think they should think about what's gone on over the last 6 months.
There you go.
Which is, it's gone up.
No, it's absolutely
Neil Dutta, I know you got to publish. We'll feature that out on Twitter. Neil Dutta with Renmac will publish. We thank him for careful market economic analysis. We now bring in Claudia Sahm, Chief Economist, New Century Advisors, and Dr. Mark Zandi, Chief Economist at Moody's. We had them on here, 30 or 60 days ago. Can't remember. It was just lights out. Great, great analysis. Claudia, I want to get this out of the way so we can move on to the real Claudia Sahm. I'm sick of the Sahm recession piñata. Can you just give us an update without tar and feathering your reputation? Are we close to a recession, Dr. Sahm?
So the increased unemployment rate is in a range where we have historically been in recessions, right? But that's a history, that's a past. We're not in a recession right now, but we do have a weakening labor market. Right. So that's the important takeaway. But not a recession right now, but a risk. Always a risk.
And what I remember from 2008 is the Zandi rule. There's the Sahm rule, but there's also the Zandi rule, which is to be optimistic about America. Mark Zandi, if we get the deck of cards I hear from Neil and others, and you, frankly, at Moody's as well, can corporations adjust and sustain off of a lower nominal GDP, decent revenue and decent earnings, or do you just suggest everything goes down?
Tom, I think they're doing just fine. I mean, looking at corporate earnings, they feel pretty good. I mean, through Q2 of 2024, double-digit year-over-year growth, and expectations of analysts always are on the high side, but they're still pretty good as well. So I think the economy is doing fine and producing enough revenue growth to keep profitability going strong. So yeah, I'm not worried about that. And just broadly, I'm all on board with the view that the Fed should be cutting rates and normalizing them very quickly. But today's report, I thought, pretty much down the strike zone. I mean, the kind of underlying job growth is 100 to 150K. That's kind of where you want it. 4.2% unemployment. That's kind of where you want it. You saw a tick up in hours worked per week. That's, feels pretty good. Wage growth is, almost exactly where you want it. I mean, yeah, you can split hairs, but come on. When are we going to say this is a good report? This felt like a really good report to me.
Is it to the point there, Mark, where the Fed can stay at 25 basis points, or is this something that some are suggesting may push them to a 50 basis point cut in September?
Yeah, I think it's 25. I mean, I would expect the Fed to cut 50 only in emergency if, markets are really evaporating or there really was some serious deterioration in the economy, job market. But I don't see any of that. So I think it's a quarter point. And there's, I think there's good arguments to cut in a consistent way. But I don't think we need to dramatically cut all at once because there's a lot of reasonable uncertainty as to where the Fed should be going here. What is the so-called equilibrium federal funds rate? What's the rate where policy is neither supporting or restraining growth? That is very uncertain, and I think given that, I'd go cautiously unless pushed to do otherwise. And I in this report, I don't see any reason to feel like they have to move very quickly here.
Claudia, over the weekend, you'll be at some fancy cocktail party, and somebody's going to come up to you and say, "Hey, Claudia, how's the U.S. labor market?" What's your response?
It's not headed in the right direction. This is the thing I'm most concerned about. Again, just, the numbers, the numbers themselves, okay, fine. It's just things have been slowing and weakening, and not because I am, hair on fire that a recession's around the corner. Right. I'm really concerned that we're losing a slipping away of a really good labor market. And we need this as good as it gets. And there should be nothing weaker than what it takes to get inflation down. And we are, the train is still moving and is not in the right direction.
I mean, to both of you, and folks, we've got huge academic caliber here. Mark, I'm going to go to you first, and then Claudia, same question. The ECB is trying to teach us about being non-measured. Are we slaves, Mark Zandi, to a Greenspanian measured approach? Careful, careful, careful. Why can't we go X beeps or Y beeps or Z beeps and see what happens? Why can't we do that, Mark Zandi?
Well, I don't know, Tom, that you need to. I mean, if the labor market was falling apart, yeah, absolutely. If the financial system was in turmoil, yeah, I'd move more quickly. But, the economy it's throttling back, but that's exactly what you'd want to see it to throttle back. For it to throttle back here, it's been growing too strongly, and it's kind of coming right into where you want it, and no reason to move quickly otherwise. And again, I keep going back to I don't think anyone knows reasonably so where we're headed here. It feels like the equilibrium rate is higher than it has been typically, and it's moving. So why not go cautiously? And if things start to really deteriorate, if we do start to see really significant job loss or even very weak job growth. Hey, one other quick point, Tom, I wanted to make.
Please.
The August data is always weak. We get very low initial response rates in the month of August, I think for obvious reasons, people are on vacation. And we always get an initial print that's on the soft side. And almost invariably, if you cast me back a year from now, we're going to be talking about upward revisions to the data. So, you just have to take that into consideration.
Yeah. Claudia, I got a 3-month moving average of 116,333, 116,333. I'm sorry, but that's way below anything I've seen as a normal rate of unemployment. If you take the 3-month moving average, Jason Furman will help out on this at Harvard. I'm sorry, Claudia, is measured in place, or is this a Fed that's got to go ad hoc forward?
Well, I think, again, it's like looking at how the variables are changing. The unemployment rate has been rising. Yes, it is still relatively low historically. We also have an older workforce. 4.3% is not that far from and experienced and esteemed, right? And so there's no magic number with the unemployment rate. It's watching the dynamics. It's watching the change and knowing that once that change is in place, the Fed has been trying for 2 years to cool off the labor market. That's why the funds rate is at 5% and other types of demand, right? So yes, things are cooling off. And now it's like, okay, now we need to turn that around. We don't need that slowing. So I think that changes everything.
Wonderful. Sahm and Zandi with us right now. They move the market higher. Futures -30, now -12. Deterioration in the Sweeney yield, 2-year yield from -7 basis points down to -9. Those levels, 365, 2-year, 368, 10-year, 30-year bond under 4%. Paul, you home shopping this weekend?
I might be, absolutely. Red headline crossing the Bloomberg terminal. Traders price in 50% chance of half-point Fed cut this month crossing the Bloomberg terminal. Mark, Zandi, given the labor outlook here and some of the data we got today as it relates to total payrolls and wages, what's your view of the U.S. consumer here? How healthy or how at risk is the U.S. consumer?
I think in aggregate, if looking across all Americans, they're continuing to do their part. They're hanging tough. I mean, the train is being driven by folks in the top part of the income distribution. And, I don't know, I don't think it's hyperbole, but their financial situation is probably as good as it's ever been. Got a job, strong real wage gains. They own stocks. Stocks are near record highs. They own a home. Home values are near record highs. If they've got any debt at all, it's a 30 or 15-year fixed rate mortgage locked in, and it seems like everyone I talk to has a mortgage at 2.5% or 3% locked in. So by my calculation, they still have some excess cash that they built up during the pandemic when they couldn't spend that they're spending down now. So I think they're fine. I do think the soft spot obviously is lower income households. They clearly are struggling. They got nailed by the high inflation. They took on a lot of debt to supplement their income, to maintain their purchasing power. And it's one thing when rates are low, but when rates are really high, that means the credit card rate is 22%, a record high. That's very painful. They don't own stocks. They don't own a home. They rent. So, very different kind of perspectives. But, at the end of the day, it's the folks in the top middle parts of the distribution that
here we go.
Are critical here.
I mean, I can't keep up. Did we tried to get John Williams on the show? Yeah. Claudia, Mark, Zandi, John Williams. That would have been good. New York Fed President John Williams says now appropriate to lower Fed funds rate. Claudia, when you were studying this in Michigan, this ex post lag, is this unusual the way our Fed is acting?
Yes, particularly in the way monetary policy is, quote unquote, supposed to be done. like in the theories, right? But that's a very clean, not realistic state. I understand why the Fed, when tools start breaking down and data don't make as much sense, then you kind of you crawl your way along and you want evidence. I think this Fed did lean into a very Fed-like tendency of being super, super cautious, and they have been kind of greedy in terms of how much data they wanted on inflation. And if I had to hear so many times, we have the luxury of time because the labor market is so strong. It's like, well, guess what? It actually wasn't as strong. And so there's a cost. Like they took time to get comfortable with inflation. But that probably means they do not have time to get, is the labor market really weakening? Like they may need to recalibrate some and get going, I think would be the appropriate. But this is really outside of their playbook. So I understand why this is a hard case to make.
Dr. Zandi, you're a pinata for the gloom crew. I mean, 07, 08, 09, you said, everybody shut up, we're going to fix this. Zandi, pandemic, everybody shut up, we're going to fix this. Give us an optimistic touch here on how America will clear these traumas post-pandemic. China's slowing down. Claudia Sahm's cats are miserable. Mark Zandi, just as directly as you can, give us, I need some Zandi optimism now, or I can't get through the weekend.
Really, I've got that reputation. I didn't know that I'm that optimistic. Well, look, just look at the numbers. I mean, top 4.2% unemployment. I mean, okay, maybe be nicer if it were 4. I'm on board with that. I mean, it's maybe on the soft side of full employment. 4.2% unemployment. We're creating a lot of jobs across lots of different industries and have been for quite some time. Inflation, that's back in the bottle, almost no matter how you measure it. So we're growing at a potential. And by the way, here's the thing that's really, makes me encouraged. The economy's potential is very strong. I mean, we're seeing a lot of labor force growth. Well, that's the key reason why unemployment is notched higher here over the past year. That goes to immigration, and there's a lot of costs there, but the benefit obviously is the strong labor force growth. And look at those productivity growth numbers, and I mean, it's hard to argue that whether it's sustainable or not, but it feels like there's a lot of good things happening underneath. All the business formation we've been getting since the pandemic hit, it's probably reaping benefit, and this is all before AI kind of kicks in. So you add up all the productivity gains, you add in the labor force growth, and that's a strong, growing economy. And the Fed's the trick for the Fed here is, let the economy take the foot off the brakes sufficiently to allow the economy to grow at its higher potential. That's a very different issue or problem if demand were evaporating. That's not what's going on here. So, objectively, take a step back and take a look around. This economy is good.
Paul, one quick question to Claudia Sahm, because futures just went green, which is a signal, go Ben Laidler.
There you go.
So quickly here, Paul, go to Claudia, and then we got to drag Ben Laidler in here.
Claudia Sahm, I mean, again, how do you just, when you sit back, you've had a few minutes to digest this, how's the Fed, how do you think they're going to digest these numbers today?
I think the payroll numbers are going to be the concern. And frankly, the piece of it that I found most disconcerting are the July revision, the earlier revisions, right? The hiring rate has gotten to too low of a place, and we're seeing it in the job gains. And then to see it, July was actually even a little worse than we thought on the jobs number. And so that, Claudia, I think that takes some pause.
She said, I was supposed to have dinner with Claudia in Jackson Hole. You know what they served? Elk. And the health food was venison. Exactly. I mean, there's no fish or nothing. Claudia Sahm, we got to go. Thank you so much. Claudia Sahm, just nailing these revisions. I want to mention Anna Wong as well at Bloomberg. And Mark Zandi, thank you so much for being with us. Really appreciate from Moody's his optimism on the American economic experiment. He is the bull strategist who has nailed the trip from 2018, from Christmas Eve of 2018. Ben Laidler joins us right now in this market. Ben Laidler, are you going to cash?
No.
I'm just busting his chops.
I just killed my keyboard here. No, I think this is I think we're in the early innings of a bull market. I think the Fed cut, which is just around the corner, and which we're all sort of navel gazing over, I think is the trigger for this bull market to broaden both by sector and by geography. I think the data today probably a little bit weaker than bulls like I would have liked, and it's probably a recipe for a little bit more uncertainty. But bottom line, I don't think it really changes the trajectory. I mean, this is an economy that is slowing. We want it to slow to pull forward those rate cuts. The Fed has a lot of room to cut here. I think that will stabilize the U.S. economy, and I think that will be very, very bullish for the rest of the world.
He's from the United Kingdom. We should properly introduce him. Ben Laidler, Bradesco PBI, with us right now. Paul?
Ben, so again, the same question I asked Claudia Sahm, Ben, is how do you think the Federal Reserve will digest this labor data today?
Yeah, so it's probably a little bit weaker than I would have liked, and probably that they would have liked. I mean, I guess we'd all be looking for that sort of Goldilocks number that last month was an aberration. Last month probably wasn't an aberration, even though the numbers were revised down a little bit today. So I think they're probably leaning a little bit more towards 50, but I think bottom line, they're going to get started. Inflation break-evens are at 2%. They've a lot of room to cut here if they feel that they need. I would like to see them get started. Right. And I think the chances of a 50 basis point cut probably increased a little bit, but I'm not sweating the pace, I think, too much. I think there's a lot of moving parts here. I think overall this is an economy which is slowing, but let's not lose some perspective here. I mean, this is an economy that we just had a 3% inflation GDP print last quarter. That's nearly double potential GDP. Unemployment just over 4%. I mean, we're coming from the start point is a very good place.
Given that backdrop, Ben, given the fact that we've got rates likely coming down, we got through a pretty solid earnings period in Q2, what are the sectors that screen well for you guys?
So I think the biggest call right now is not necessarily the direction of the market, which I think is pretty well set and up and to the right. I think it's more about the sectors you own and which parts of the world you own. I think this is a broadening bull market. I think tech's been a great place to be. It's nothing wrong with tech, but I think the bits of the world and the sectors that are much more sensitive to these interest rate cuts which are coming. It's not the US and it's not tech. It's basically everybody else. All these are the bits of the market that we've forgotten about for the last 10 years. That's, I think, where you should be kicking the tires on right now.
Ben, I don't have Apple in front of me, but you were way out front, 2018, 22, 23 and all. I'm hearing, Paul, you're hearing a lot of death of big tech. I am. Ben Laidler on the Mag 7, the Mag 8, including Berkshire. You still got to own them, right?
Yeah, I think so. The earnings numbers are decelerating, but they're still, no one else comes even close. You've got these fortress balance sheets. You've got these huge profit margins. With all that, I can more than justify, the valuations. But we all know that they're posting strong growth. The valuations are, already at premium numbers. That's not, I don't think, where the surprise is going to come. That's not where the sensitivity to lower interest rates is coming from. It's everybody else that has those shriveled profit margins, that has those, depressed earnings expectations. We've just come out of an earnings recession where valuations are 40, 50% lower. That's where I think you're going to get the bang for your buck in this sort of broadening bull market and potential change in leadership.
Too short a visit. We got to get Ben Laidler on again. Next time Tottenham wins, we'll get Ben Laidler on. Ben Laidler, thank you so much with Bradesco this morning. Paul, your observation here.
Yeah, I think as Claudia Sahm, Mark Zandi kind of highlighted here, it's still a strong, fairly strong labor market, but slowing. I think Neil Dutta is more bearish, saying, hey, the underlying weakness, I think Claudia Sahm is there as well, the underlying weakness is probably the more pronounced aspect of the labor market, that the recent trends have been weakening, and those recent trends argue for the Fed to step up here. And whether it's 25 or 50 basis points, the market right now, as our Bloomberg News is reporting, is pricing in a 50 basis point rate cut in September.
Paolo out on YouTube. We are listening to witty, smart, not young people.
Okay.
This morning we're not young.
All right.
That's except everybody.
Lisa's young. I'm not young. But
we say good morning to all of you new to the Jobs Day 92.9 FM Boston, from Millinocket down to Block Island, which means you play Jay Giles or Joan Jett. Good morning.
Love stinks. Love stinks.